Yeah, thank you. Good evening and a very warm welcome to DLF Limited Q4 and full year earnings call. Thank you for joining us for our earnings call. We hope all of you are safe. Before we get into the results, I have an important news to share with all of you. This also came out in a press release yesterday. Dr. K.P. Singh, Non-Executive Director, Chairman of the company, has been at the helm of affairs of the company and the DLF Group for over 5 decades. As part of the succession planning, Dr. K.P. Singh, by letter dated 4th June 2020, tendered his resignation from the position of Non-Executive Director, Chairman of the company. The DLF board also approved the appointment of Mr. Rajiv Singh as the new Chairman of DLF Limited. Dr. K.P. Singh will nonetheless continue in a non-executive role as Chairman Emeritus. With this, let me get back to our business. So our business exhibited a strong performance during this fiscal. We have demonstrated resilience and remain committed and confident in delivering our business goals. I'll start with the key highlights of the quarter first. So our consolidated revenue stands at 1,874 crores, an increase of 22% compared to Q3 financial year 20. Net profit at 323 crores before exceptional item and DTA reversal grew at 17%. I'll talk a bit about the exceptional item now, which we reported in Q4. In view of the COVID-19, after a thorough analysis and following a prudent approach, the company has undertaken certain provisions to reflect changes in the carrying value of some of its assets and investments. This has led to a one-time exceptional provision net of taxes of rupees 272 crores. Further, there was a one-time DTA reversal of rupees 1,916 crores on adoption of lower tax rate. As you know, there was an option to change from 35 to 25% tax rate, and that the company has adopted starting 1st April 19. This will improve profit and reduce cash outflow in future years. After exceptional items and one-time DTA reversal, the company reported a loss of rupees 1,865 crores for the quarter. Now I'm moving to the full year results of DLF Group Consolidated. Consolidated revenue of rupees 6,888 crores. Net profit of rupees 1,323 crores, excluding one-time DTA reversal. As called out earlier, there is a one-time DTA reversal of 1,916 crores on adoption of lower tax rate. After considering the one-time DTA reversal, the company reported a loss of 594 crores for fiscal 20. The board declared a final dividend of rupees 0.8 per share for the fiscal. An interim dividend of rupees 1.2 per share was announced in the previous quarter. This makes a total dividend of rupees 2 per share, consistent with our previous periods. I'll now move on to the full year financial year 90 performance of DCCDL Group, which is the rental arm of DLF. Operating revenue stood at 4,435 crores, an increase of 12% from previous year. Net profit at 1,317 crores. Strong net operating cash flow, rupees 2,597 crores. This is before capex. I'll just move on now to the industry outlook. COVID-19 and the consequent lockdown has impacted the global as well as Indian economy. This has created uncertainties, and we expect some near-term impact on the real estate sector, especially residential and retail segments. Office sector continues to demonstrate resilience. We expect demand to remain muted in short term as this pandemic appears to have impacted consumer sentiment and spending appetite. We believe that it is too early to gauge the full impact caused by this crisis, hence the industry will tread with caution in the near term. Hello, operator.
Yes,
Hello,
sir.
operator. Yeah, we've been receiving some complaints that people are not able to log in. Can you please check?
Yes, sir. We'll have that check.
And Mr. Tyagi is also dropped off. Can you please patch him in?
Yes, we are dialing him out, sir.
Yeah. Sorry for the interruption.
So I'll just stop here and wait till the time we get everybody back. Yeah. So if you can integrate it. So you can just let us know, operator, you can just let us know when everybody is back.
Yes, sir. We have Mr. Tyagi reconnected. We are connecting the others as they call in.
Okay, I'll wait. Yeah.
Participants, please stay connected while we wait for others to join in. Ladies and gentlemen, please continue to hold your line while we wait for other participants to join the call. Thank you. Ladies and gentlemen, thank you for patiently holding your lines. I now hand the conference over to the management. Over to you, sir.
Yeah. Sorry for this technical glitch. I don't know where I dropped, but in the interest of time, I'm not going to repeat the financial performance because that's already shared with all of you. Let me straight away start with industry outlook. COVID-19 and the consequent lockdown has impacted the global as well as the Indian economy. This has created uncertainties and we expect some near-term impact on the real estate sector, especially residential and retail segments. Office sector continues to demonstrate resilience. We expect demand to remain muted in the short term as this pandemic appears to have impacted consumer sentiment and spending appetite. We believe that it is too early to gauge the full impact caused by this crisis, hence the industry will tread with caution in the near term. Interest rate reduction proactively effected by RBI has been well received by the industry. More sector-specific relief in the short term to spur demand will be welcome. Lending institutions are expected to be risk-averse, thereby accentuating funding challenging for stressed developers and accelerating consolidation. The company retains a positive outlook for the long term on account of its healthy balance sheet, strong brand image, and unwavering commitment to quality. The group has met all its stakeholders' commitment the company has not availed any moratorium or deferment on its debt obligations. The company has sufficient liquidity to sail through the uncertain times. The crisis has presented an opportunity for DLF to undertake exercise in being leaner and more efficient in terms of its cost structures. Our heightened approach to cost optimization is expected to help ensure healthy margins in the times to come. DLF has observed sustained success in office rental collection. It has provided comprehensive business continuity support to all stakeholders and continues to receive positive feedback from its tenants. Owing to the extended lockdown, malls across the country have not been operational, and this has led to some short-term pain for the tenants. We continue to maintain a connect with all our retail partners, supporting them through these uncertain times. With opening of the malls expected in June, our focus remains safety, hygiene, and well-being of our customers, tenants, and teams. DLF has ensured that it remains in the unique position to recommence work as soon as lockdowns are lifted. Consequently, the company has not lost any time beyond the mandatory lockdown period in its project commitments. We anticipate that some semblance of normalcy may return from Q3 financial year 2021, whereby players with strong operational expertise and financial resilience will continue to gain foothold. While our liquidity, balance sheet, brand image, and product quality inspire confidence to withstand these uncertain times and enable us to stay committed to our strategy, we remain vigilant and agile to tackle any unforeseen challenges that may arise. With this, I'll end a brief update. Thank you for patiently listening to me, and we open the floor to questions now. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. We take the first question from the line of Abhishek Bandari from Macquarie. Please go ahead.
Yeah, good evening to all the management team. Tyagiri, I have 2 questions. First one is on the rental business. First on the office side, if we understand that the near-term demand has, gone away and it's likely to come maybe after 6 months or so. But could you share, does it in any way alter your growth plans for DCCDL? And what kind of rental growth do you think can be, got by the company over the next 2 years' time on the office side? And similarly on the rental side, what kind of concessions have you given to the tenants in retail malls? Have you given some kind of rent waivers, or also have you been able, or have you changed some of the rental contracts from base plus minimum guarantee to a higher minimum guarantee of things? Color on this will be helpful. Thank you.
So thanks a lot, Abhishek. On the offices side, and so first of all, I would like to, paraphrase, because, today you sit on TV, everything, there's tons of, if I may say so, gyan being given. I mean, all of us are working with 8 or 10 weeks of actual data and trying to project medium-term trends on that. So that's the, sort of disclosure I'd make. Look, April and May, our offices collection has both been, 90% plus. April has been 90% plus. May, I think we've already done the early 80s, and the balance pieces are coming hopefully in the first 2 days of June, so we'll again hit 90% plus. So how does it impact the medium term? Honestly, is an open question right now. We had 2 capital projects, that actually 3, if you ask me, which were on the anvil. Cyber Park is complete, and the tenants who are doing the fit-outs continue to do their fit-outs. And we hope that now with the lockdown on construction ending, the final completion pieces should be done in the next few weeks, and tenants can begin moving in there in the next couple of months. The two new projects that we had launched was a downtown in Gurgaon, which is eventually a 11 million square feet project, but we had commenced construction on the first 2 million. And similarly, the downtown Chennai, which is again a 7.5 million square feet project, where again we had commenced construction on the first 2 odd million. So obviously, the last 2 months construction was completely shut down because of the lockdown. But as the lockdown's been lifted, to some degree the workmen are there, and the construction is recommencing in both of those sites. I believe that in this entire disruption, we would have lost a few months to the construction schedule, maybe 4 or 5 months. Let's see how much. 3 months of actual lockdown, maybe another month or so for the construction teams to reassemble. But we continue, so far, we continue to be committed to both of these projects. Maybe the phasing beyond these 2 million may be slightly more calibrated. But since our first phase was 2 million each, in both capacities, in locations where we are completely run out of capacity, we continue to be confident on that. As far as the medium-term, demand outlook on the offices piece is concerned, I think it's a motley of a variety of things. Clearly, work from home, which is the the elephant in the room. Everybody is naturally talking about that. We believe that on some hand, it could have a marginal impact on the demand, but in all fairness, it also makes the improve the quality of work-life balance and the flexibility of working. And we do believe that to offset that, there will be demand driven by de-densification specifically. So the offices demand could be slightly more tempered in the next few months, but we don't foresee it going anywhere fundamentally. Also, India's fundamental strength as a destination for the knowledge-based services specifically, I think that isn't going to go anywhere, especially as the rest recovers. On the retail side, there's been a complete lockdown since March, mid-March. So obviously for the last 3 months, there's been a lockdown. Now, as we know that some steps are being announced to reopen the retail mall piece. In the last 2 months, to be fair, we haven't collected from the mall, from the retailers, and we have been in constant communication with them in terms of, obviously, from their standpoint, they would want some concession. From our standpoint, let's face it, we have our own liabilities, etc., to look for. But I think all the big retailers are sort of working with the tenants, and we believe that once the malls open, hopefully in the next few weeks, we should be able to arrive at some understanding of how to handle specifically this quarter in terms of the rental adjustment, if any, that may need to be done for select retailers. Right now, it's still a work in process.
Okay. So my second question is on the residential business. While it's great to hear that you have not sought any moratorium from the banks on the loans, but how are your cash collections tracking from the customers? The reason for asking this is, that could give us some understanding how much percentage of the customers might be using bank loans and are still probably paying you and are not seeking any kind of, moratorium from you as a company. And a related question on that, do you think if your construction is going to remain on track for these 2 quarters, and there could be slight slippage on collection, the debt number might rise beyond the 1,300 crore what is to refinance?
So look, our collection outflow on the projects that are active right now, and I'm not counting the new projects that we are commencing like Midtown and all, which have separate construction financing, lines of credit available. But on the existing projects, whatever residual cost to completion is, and Vivek can chime in, I think it's a number of outflow of not more than 500 to 600 crores for the fiscal 2021 in terms of construction outflow of the development project. So frankly, we believe that I think while obviously April collections were clearly, they were very poor, and I think that's not surprising. By the later part of May, collections have begun strengthening. We still believe stand by what we wrote, that Q1 would be pretty weak on collection. Q2 we expect, things to begin returning, and by Q3 we expect a degree of normalcy to come. I think that is true for the sector as a whole also. But again, basis are very extremely limited construction outflow commitments. We don't foresee that to dramatically impact our overall cash situation, for this. I mean, in a very perverse sort of a way. While the collections were weak, the fact is for the last 2 months, the construction outflow was almost near zero. Again, because construction was shut down as well.
Sir, I just want to add to this, Abhishek. See, in quarter one, starting April, I think the company took a conscious call on the residential side not to raise any demand on the customers, because like all of us are going through tough times, so are the customers. And therefore, there was a conscious call not to raise any demand for April and May, and therefore our collections have got impacted. But it's not going away anywhere. It's just going to really come in June, July. So having said that, we've raised the demand now, and the collections have started coming in from second half of May into June, right? So that's one, right? So of course this quarter, the way I see it, collections have got impacted. But when you really look at the total liquidity position of this organization, especially on the residential business, and I can explain the rental arm later, right? We started with a very healthy cash in hand of 2,500 crores. And we have a debt obligation between debt repayment and interest of less than 2,000 crores, right? So I'm really fully covered there. And if I really look at my receivable and new sale, right, and my rental business, which is sitting in the DevCo side, that is good enough to cover my operating expenses for the full year basis. So therefore, right, with the healthy opening cash in hand and what is really likely to flow in, we are very confident that we will be able to meet all our obligations, be it operational, be it financials, on a full year basis. Yes, quarter one, there is a slow start as far as the collections are concerned.
That's understandable, sir. Thank you and all the best for fiscal 21.
Yeah, thank you, Abhishek.
Thank you. The next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Hi, sir. Thanks for this opportunity. So basically 3 questions. One is, you've spoken about conserving cash and liquidity. So in that context, I just wanted to ask that this dividend payment that you're doing, right? I mean, you paid 500 crores, 2 rupees in F20, and you still announced 80 paisa. The point is that DCCDL dividend can actually be used at DLF level, and kind of, improve the balance sheet out there. So I would just wanted to know that in fiscal 21, you expect to still pay the dividend, or would you expect it to cut? And my broader context is, if you look at broader set of companies, most of them are guiding to very substantial dividend cuts. So that's first. Secondly, on this cost, it's good to see that you've reduced it in this quarter, but what is now the target which you are effectively running at in the company? And the third is essentially on this DTA reversal, sir. Effectively, I thought we were not doing it because we had a lot of MAT credits. So that 4,000 crores of deferred tax asset that we had, does that still remain? Or, my issue is that should we see the cash outflow on account of tax still be lower? Kind of low levels we sustain, or will those credits go away? So these are 3 ones. Thank you.
Okay. So I'll address the last one first, Saurabh. So I have to make a comment, Saurabh, and that is to place on record my disappointment that you ceded your opening slot to Abhishek this time, but that's fine. Okay.
I didn't do that. It's fine. Abhishek was too quick.
So, on DTA reversal, please appreciate, we have historical tax losses because of which we do not need to pay any taxes for the next many years in DLF Limited and as well as in BHDL. That situation does not change. So far, its losses were at 35% DTA. Now they will be DTA at 25%. However, when we done the Ind AS transition, there was a 5-year period for MAT adjustment that was given, which is expiring on 1/4/21. So beyond 1/4/21, even if I had no taxes to pay, I would have been subject to MAT on the entire set of profits that was made in the DevCo. So as an example, if the DevCo made a profit between 1050 to 1,000 crores, about a couple of 100 crores per year of MAT would definitely have gone out. As you know, the MAT credit can be adjusted only for the difference between the normal tax outflow and the MAT. We would not have any normal tax outflow to make, but only MAT. So the outstanding credit of the 200 odd crores would not have been adjusted in our assessment for the next 7 to 8 years. So basically the advantage of switching to the lower tax rate was twofold. A, to clearly improve the book profitability by 10% a year. And B, to ensure that there is no MAT outflow for the next 5 to 6 years at least. In the case of Cybercity and DLF Assets Limited on the RentCo, there the MAT credits are far higher and the ability to utilize them obviously is also stronger. So we have not embraced the lower tax rates on the RentCo side. We have only embraced them on the DevCo side. That's part A.
Okay.
Part B, on the dividend piece, let's face it, the dividend of this, whatever, the 80 paisa dividend now is being paid for fiscal 1920. And frankly, fiscal 1920, even if we were the most uncharitable, wasn't any worse than 1819. So we felt that the shareholder dividend should be maintained. This dividend, as we have always maintained, will be met by Cybercity, which will now this year give a reduced dividend, but even then enough to sort of do the 80 paisa dividend that DLF liability is. Now, the dividend of 2021, which is to be paid next year, honestly, frankly, is a function of Cyber's profitability next year, DLF's profitability next year, and how the entire cash flow and the situation bounces back, frankly, in that sense. So I think right now it will be very speculative for us to comment on the dividend payable for the fiscal 2021. That's it. On cost, Vivek actually is the expert, so I request Vivek to speak on the cost.
So Saurabh, on the cost, fixed cost, which is the cash-based fixed cost, which is sitting in other expenses, this year is close to 500 crores. And we are running a target of really bringing it down to half, right? And I must just talk about the kind of things we have done. I think for the first time, we've done a zero-based approach. Very clearly, we've identified the non-essential costs which have been driven or we've been carrying them because of legacy. And we've taken some hard calls, right, in terms of really cutting those costs. So we started this exercise in the beginning of the year, and actually COVID helped us to really expedite it. So we have started seeing the results starting April itself.
Okay. So, point is, if I look at this quarter annualized, it's about 600 crores. So what should we think about this for fiscal 21?
So in the entire fiscal 1920, our overhead, if you will, were in the range of about 800 crores for the entire fiscal. And frankly, for us, we are looking at least hopefully a 40% cut on that, if not more.
Yeah. So
Vivek, internal targets are actually more aggressive, but 40% is clearly something we're very comfortable to speak with you about.
Yeah. You're right, Ashok, you're right. Just wanted to add that this 600 plus number, what Saurabh you are seeing, has two components to it. One is the fixed cost, and there is also some marketing and brokerage cost which is sitting here, which is more of a variable cost linked to the sale. So that piece is linked to sale, right? So since it's variable, I will not comment on that. But the fixed piece, as I talked about, we are really looking at bringing it down to half.
Okay, got it. And just one final thing, DC serial EBITDA, if I just add Cyber Park, we should probably touch 3,600 and whatever discount you then give on the rental fees. The retail fees, right? Is that the way to think about DC serial?
Yeah, that's right.
Okay. Thank you. Thank you, sir. Thank you.
Saurabh, thank you.
Thank you. The next question is from the line of Nikunj Mehta from HSBC Asset Management. Please go ahead.
Yeah, hi. Thank you for the opportunity. Hope everyone at DLF and the team is healthy and safe. Just had a few questions on the residential piece. So starting with Camellias. So what were the, in terms of number of units, what were the cancellations for this quarter, and so far in the last 2 quarters, what will be the cancellation numbers? That's one. And second, do you think that because of the COVID and some of the buyers might decide to cancel flats in Camellias, if there is a possibility of that? That's the second question. And the third one is on our development pipeline for the residential business. Last quarter, we mentioned about the 7 million odd square feet of new development in terms of independent floors. So how do you look at this post the current situation? Is there any deferment, or you are sticking with the timeline of launching it in second half?
Okay, let me take this on. So on Camellias, if you see the difference between the gross sale and the net sale for this quarter, as we indicated in the analyst presentation, is largely because of the sales cancellation we have in DLF 5. Now, but I don't have the exact number, but I think in terms of cancellation, it will be sub 20, what we are really talking about. And this is, in fact, this is the reason why this cancellation happened, because these are the set of customers who were not able to start the fit outs. So therefore, we had to really cancel it, as we indicated in the previous analyst call, right? So this is not something, so we made sure that this quarter we cleaned up the entire thing. Now your question is, are there more expected in future? The answer is no. This is behind us.
Okay. Perfect.
Okay.
Yeah. And the reason for that also is that of the whatever 245 odd customers who are now the active Camellias customers, I think more than 200 plus are already in an advanced stage of their fit out work. So they are already investing their own 3 to 4 crore rupees to fit out. So hopefully, the cancellation story, unfortunate as it was, looks to be behind us on the Camellias piece.
Yeah.
Okay.
Yeah. And also, just to add, I think during the lockdown itself, right, when there was hardly any activity, we also had some few Camellias being sold during that period as well. So I think we also expect our club to be operational in second half of this fiscal. So therefore, with habitation coming in second half, as people complete their fit out, and with club getting operational, we expect the sale velocity of Camellias to improve in second half.
Okay.
Yeah. Now on the new development you talked about on the independent floors, so I think we still remain committed to our strategy. That's the first thing I'll say. I think we made good progress in the last 3 months in terms of really getting the design approved, getting all the approvals in place, right? And we had almost started the construction work, but because of the lockdown, we had to really suspend that. So in terms of our plans, at this point in time, we are just waiting for things to clear up, and of course we will have to really look at the right time, but we remain committed in terms of really launching this in second half of this year.
Okay.
The only other point I'd like to add to what Vivek said, which is important, I think, development from our side, is that given the entire disruption on account of COVID that's happened, the 3 or 4 months that we would have lost in the cycle, we have now also taken the decision that for both the independent floors as well as for the Midtown project, which is our JV with GIC in Delhi, we will not wait for construction to complete before offering it for sale, as was our philosophy and stated the objective earlier. We would commence the sale. We would not delay the launch cycle disproportionately, and hopefully, trying to bring all of these projects to the market, within this fiscal, which is Midtown. And if I may say so, the 3 tranches of the floors in Gurgaon, one is the floors in DLF City, then is the floors on our Garden City in Alameda, which is in the New Gurgaon, and C is, we were also working out with the Haryana government's new scheme under the DDJY and NILP to actually get extremely optimally priced, floors. to the market. So I think all of these segments would hopefully, start seeing the launch pipeline towards the later part of this year.
Okay. So if I hear you correct, even the Midtown project of ours, you would see that you will be able to launch this fiscal.
Yes, absolutely. Unless, of course, there's something catastrophic that happens on the demand front. But right now, the way things are, we are clearly looking to launch it towards the later part of this year.
Okay. And if just the last question from my side, if I can squeeze in terms of our cash flow ex GCCDL, so the questions are asked on the OPEX front, but on the CAPEX side, if I look at the numbers, which is around 250 odd crores, which we used to do the last 2 quarters, this quarter it was around 291 odd crores. So what the kind of sense do you think on the CAPEX side in terms of annualized FY21? What kind of CAPEX are you looking at in DLF ex GCCDL?
So on the development business side, we have an estimate of close to 500 crores for financial year 2021. And on the rental business side, it's estimated to anything between 750 to 800 crores. Because our big projects of Cyber, Downtown Chennai and Gurugram, these are the 3 big projects which are going to need this level of capex. But we are also really looking at doing construction funding for our 3 big projects in the rental business side, and depending on how fast normalcy comes in terms of construction activity being picked up, we may be able to expedite or spend more in case we are able to land funding in time.
Okay. Understood. Thank you.
Thank you.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, thanks, and good evening, everyone. So just taking from the previous participant, you said capex for DLF excluding DCCDL is 750-800? That was the question.
No, so about 500, Sameerji.
Yeah, that's 500.
And that, okay, got it. So 750-800 was really DCCDL. That's what you were talking about.
Yeah. So 500 plus 750 equal to 1250 total.
Okay, got it. So, just on the net debt side, 2 questions. What's the outlook for this? I know it's pretty nebulous, but what's the outlook for this next 12-15 months? How are you thinking about it? And there was a plan earlier to monetize certain land parcels. I think there were non-Gurgaon commercial land parcels, and also some TDR monetization. So where are we in this cycle?
So Sameerji, the TDR policy still hasn't come out. The Haryana government still hasn't notified the TDR policy. So while the plans of that monetization are in place, they can't be acted upon till such time that the policy gets notified. Yeah, I presume because of the entire lockdown and all. But the the policy hasn't been notified yet. So that is clearly one thing. On the net debt, frankly, I would say that if it's okay by you, purely within this quarter with so many uncertainties, we would normally desist from giving any guidance either on net debt or sales. But our endeavor will be to ensure that the net debt clearly does not go up, in any meaningful way. And hopefully by the second half, once we are able to actually put these new launches into the market, we are able to show a decline of it as of March 21. But in all fairness, I think Vivek and I will be far more confident of giving you a trajectory in the July or the early August call than we are today, frankly. On the monetization piece, the same thing. Those assets are there, clearly. It's just that, today, frankly, as we speak, there are no PE discussions happening, especially on the commercial piece. So while we remain open, and we will obviously at some stage, once the things open up, come back to those discussions. We're also looking at alternate plans of monetizing some of those projects, including, maybe in some cases at least, build and sell of certain commercial pieces as well.
Okay, great, sir. And the second one is on your 2 projects, Camellias. You gave us some color, but what would be the revenue recognition trajectory going forward? And for Cyber Park as well, when does the cash start to come in? And how would be the revenue, the rental recognition for this one?
So for Camellias, we expect the possession to start sometime in Q3. That's the December quarter. So that's the time when the habitation will start, and that's the time the revenue will start getting recognized.
Okay. And for
and Cyber Park, we expect the revenue to start coming in from August.
Is it from August?
Yeah, that's right.
Okay, that's great. And so final question from my side. If you can update us on two more pipeline projects. One is Heinz Commercial, and the second is new Phase 5.
Okay. So the Heinz Commercial, which is the JV with Heinz, currently, while we were progressing on the entire 3.8 million square feet development, frankly, given all that's happening, in post-COVID in the commercial cycle, both Heinz and we are under extremely active discussion, almost on a twice-a-week basis, to basically, evaluate options on does that project need to be tweaked in terms of the specific, target products that we were making, as well as the phasing, frankly, of the same. So I think, again, Heinz is a project which, again, both Heinz and I, as well as Heinz's LP, they are firmly committed to. But I think we would, again, be maybe a couple of months away from actually being able to define for you that of that 3.8 million square feet, what is the Phase 1 of that Phase 1, is it 100% for lease, is it part for lease, part for sale? All of those are discussions that, frankly, are currently engaging both Heinz and us.
Okay. And for Phase 5 new Resi project?
So Phase 5 new Resi project, frankly, right now what we will do, Sameerji, for this year at least, our focus is on the independent floors in the phases 1, 2, 3, 4, 5, including Phase 5, which also has a lot of independent floor potential inventory. So we would focus first on that. And the sort of, the new Phase 5 premium luxury development, we clearly are not proposing this year because we don't want two products in the same geography to be competing with each other. So the independent floors in the DLF city should definitely hit the market this year. I think the new Phase 5 is something which may be a later step, because this year we'll have a luxury project in Delhi, which is the Midtown, and these independent floors in Gurgaon in DLF city. The high-rise Phase 5 project may actually be deferred by a couple of quarters.
Okay, great. Thank you so much.
Thank you. The next question is from the line of Kunal Lakhan from DLF. Please go ahead.
Yeah, hi, good evening. Firstly, just want to understand how much would we have collected in Ultima so far in terms of percentage collections?
30% I think we'll just take this question and possibly share with you separately what is the actual collection till now. But I think you can go ahead with the question. In the meantime, we'll just give you the number if we can.
Sure. Also, in terms of the cancellations pertaining to Camellias, right? So how are we treating these in terms of are we giving a partial or a full refund to the customers, or how are we treating them?
No, we have given a full refund. We have given a full refund because, frankly, Kunal, these were extremely extraordinary times. So, frankly, we did not want to necessarily penalize anybody. So, for this brief limited window of Jan to March, we actually, allowed the customers to be able to exit without any hit, short of any brokerage or anything like that, sort of a thing. And clearly, going forward, I think we'll come back to our normal commercial discipline. But given the entire extraordinary pieces that were happening in the last few months, right now for Camellias, we've allowed people to go out.
So just clarifying, so the collections from sales that we have shown in the consolidated cash flow, that is net of any refund that would have given to customers,
yes,
right?
Yes, sir.
So the balance sheet impact of these cash flows or this cancellation is already there in the existing balance sheet, and there is no subsequent impact of these cancellations in the balance sheet, right?
I think there is, Vivek, if I'm not mistaken, there would have been about 70-80 crore overflow into this quarter also.
Yes, sir, that's right. Around 80 crores. 80 crores is this quarter. Otherwise, the entire thing has been settled in the previous quarter.
And even this 80 crores has been completely settled as we speak. So as we speak, there's no overhang at all. But because,
yes,
the cancellation that time needs the bank's NOC. So some of those customers were unable to conclude their transaction by March 31st. So I think some of them flipped over into April.
Yeah. So now as we speak, this is behind us. Yeah. And Kunal, to your question on Ultima collection, I have the numbers. So out of 1,000 crore sales, we've collected 300 crores.
Perfect. Just last one from my side. Can you just elaborate a little on the exceptional items of 330 crores? I mean, how have we arrived at this? And just wanted to understand the extent of impairment and provisions you have made, and is there any likelihood of it recurring in coming quarters?
So I think very clearly in view of COVID-19, after the management has done a thorough analysis and we actually followed a very prudent approach of really going through all our assets and investments, right? So, and we've really looked at all our assets and investments and critically, and as you know, we are into business of hospitality and we have significant assets in that space, be it clubs, be it hotels. And you know that the retail side has been impacted because of the lockdown situation, and also the build-up is expected to be slow in the financial year. So that has impacted our cash flows, and therefore that has caused to the impairment of these assets. So I will say that a large part of this 330 crores is coming from the hospitality sector, which is basically our clubs and hotels. And we've also looked at the other investments and advances what we made, right, for development. And we've really also taken a prudent approach in terms of really making provision where we felt that there is an exposure for DLF. Right. In case you want details, we can separately off the call. We can share more details with you.
Sure. That's helpful. Just one more, if I may. Just in your earlier presentation, you had shared those slides of rental gap and ramp up to FY22 of 4,700 crores. What, in your best assessment, that number would be in the current environment?
Okay. So, sir, with due respect, there is a reason that slide is not there in this deck. Because, and I mean, jokes apart, in all fairness, we want to only do two things. One is that what is the construction disruption that has happened, and so in that sense that March 22, that will definitely move forward, but is it moving forward to like July 22 or September 22? We just want to get a better estimate of that. B, in all fairness, we just, hopefully by the end of Q1, we want to be in a slightly better estimate on how this so-called this retail story is panning out. So clearly, it's our commitment that in the Q1 deck, that slide will be restored. It's just that given the uncertainty that's currently happening, we just wanted to take some time off to retweak the timeline on that slide correctly.
Thank you so much.
To reassure you, the projects that made up that 4,700 continue to be on track.
Okay. All right. Thank you so much.
Thank you. The next question is from the line of Murtuzae from Kotak Securities. Please go ahead.
Yeah. Aisha, thank you for taking my question. Two questions I have. One is, how much of your DCCDL portfolio is coming up for renewals in the current year? Number one. And on the two projects, which is Cyber Park and the Chennai project, how much has already been pre-leased on that front? And the second question that I have, which is more bookkeeping, if you could tell us what is the revenue recognition for the development business for the current quarter and full year FY20 in the development company.
So
So coming to the question on the area which is coming up for the term completion in DCCDL, that's roughly around 2.3 million square feet for the year. And on the pre-leasing on the downtown, so in the downtown, the pre-leasing which has already been achieved is 2.7 lakh square feet. And in downtown Chennai, since we have just launched the project in terms of our construction activity has just started, we are actively marketing it, and we are in advanced discussions, but no closure as yet.
Right. But, sir, on Cyber Park and the other Chennai ITSZ project, which have just about been commissioned?
Right. So the Chennai, the ongoing 2 blocks, which is block 11 and 12, which is 8 lakh square feet. Of that, hardly I think 1 lakh square feet is unleased, balance all is leased. On the Cyber Park, the complete office area, which is 2.4 million square feet, is completely leased. The retail area is also 60% leased, and the balance we are will be looking at a closure very soon.
Sure. Thank you. And on the question on residential revenues recognized in the quarter and for the year.
Yeah, you can just note down. For the quarter, it is 1,500 crores, and for the full year, it's around 5,000 crores.
Sure. Thank you so much, sir.
Thank you. The next question is from the line of Nilang Mehta from HSBC. Please go ahead.
Good evening, sir. My question pertains to our receivables positions, which doesn't seem to be coming down quarter by quarter, and it has been pretty stagnant. So can we get some timelines over which we expect the receivables to be, cleared and as they come out? Because we see there are no, most of your sales have been done, and the receivables aren't coming down. So, and any risk of any write-downs you need to take on them?
Okay. So we have 2,500 crores of receivable as we get into this financial year. I think we've collected well in the last quarter, right? I can share the numbers with you, but I think our collection has been...
December end it was 2850, so only 300 crores have been collected, which I think so you mentioned is related to Ultima. That means your rest of your receivables, you have not done anything.
No, Nilang, 700 crores was collected because there was also a fresh sale of 400 that happened. So the 2,800 crores come down to 2,500 because of 700 crores was collected, but 400 crores was a fresh sale.
Yes, that's right. So from the receivable, it's been...
So despite that, sir, 2,500 crores of receivables, and cost of debt today is 10% or 9% for you guys. It's a huge negative carry which you're carrying. So I'm unable to understand why aren't we be more aggressive to get these receivables cleared? And if they're not getting cleared, why don't you write it off and clean up the balance sheet?
Okay, I think we can share some more data on this, but I think first of all, I think we are confident of really recovering this 2,500, and we have put strong plans, aggressive plans in recovery for this year, quarter on quarter.
So this is the answer.
Also, the entire 25 is not falling due in the year.
So this is the answer.
The entire 25 is not a past due.
1,800 plus 700 new sales, gross sales.
So the 2,500 crore also includes the receivables which will fall due in the coming quarters, in that. But Vivek, why don't you do a detailed analysis of the receivables, and then Monday we could offline.
Because I don't see any sales happening. If you see National DevCo receivables, they're all pretty stagnant. They are all in a 100 crore range all the time. So I am not understanding where are the sales happening and where is
share some numbers. I think let's focus on last quarter itself, because that's something which is actual, right? So while we can talk about the fact. So we started with 2,800, right? Now I have the numbers in front of me, and we've actually collected 1,000 crores out of it. So that brings it down to 1,800, and we've added new sale of 700 crores. That makes it to 2,500, right? So I think there is enough focus in terms of really making sure that we fully collect the receivables on time. Yes, there are certain receivables which are overdue, All I want to assure you at this point in time is that as management, we are committed in recovering this during this next financial year.
Sure. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Abhinav Sinha from Jefferies. Please go ahead.
Yeah, hi. Thanks for taking my question. So just a quick change in the residential strategy. You're saying that A, there will be some mid-income launches this year, and B, you are willing to sell very close to launch. So what has prompted this change? And also, what do you mean by mid-income now?
So the mid-income, honestly, which is basically the new Gurgaon piece, could be stuff ballpark in the 75 lakhs to 1.25 crore range.
You said 75 lakhs, right?
75 lakhs to 1.25 odd crore range.
Okay.
In select pockets, it could be products which are priced slightly lower. In select pockets, it could be products that are priced slightly higher. But I think the median will be somewhere in that range.
Okay. And what prompted the change in strategy? Selling on launch?
Oh, no, so we're not selling on launch. I mean, we're not selling on brochure, frankly, as some of our peers do clearly. We are just saying that we are no longer, very the strategy necessarily of selling post-completion. Primarily, A, we have lost 4 or 5 months, eventually in this year to COVID for construction. So, if we were actually to be completely faithful to our old strategy, many of these launches will actually overflow into the next year, which is something that we wouldn't like. Partly, frankly, also given the uncertainty in the market, I think it is important to have a committed customer at a relatively middle stage of the cycle, versus actually having to wait for completion and then go out for the customer. So I think it's both linked to the uncertainties that are prevailing right now, and frankly, to some degree, trying to fortify our customer base as we keep on completing these projects.
Okay, and just one query here also on your Delhi project with GIC. What shape will the building be roughly when you are launching it? Just to get an idea.
So clearly, we hope to be out of the basement.
Okay, thanks. And so just one last question. You have given certain GAV calculations on DCCDL. Can you share the assumptions behind them? Thanks.
So we have not given any. So it's not a subjective thing. Now, as you are aware that under the new accounting standard, every year on 31st March, you are supposed to get a designated valuer to value all of your investment property. So this is basically a reflection of the GAVs computed by those IPCs for Cyber City, which are a part of Cyber City's signed balance sheet as of March 20. These are not based on how would we look compared to a REIT, or how would we look if my cap rate was 5.5% or 4.5%. None of that. This is basically the IPCs have a certain method of valuing the investment assets. They have done those valuations. As a part of the Ind AS regulations, we are supposed to mention the GAVs in the balance sheet, and this is a reflection of that.
Okay, sir. Thank you.
Thank you. The next question is from the line of Chanchal Khandelwal from Birla Mutual Fund. Please go ahead.
Hi. Most of my questions have been answered. Just one thing on the guidance of residential sales. I know first half being difficult, you may not give any guidance. But just a thought process. Last year you gave a guidance of 2,700 crore and you finished the year just around 2,450 crore. What's the guidance for next 2 years and how will you try and achieve it? Because in the presentation you have spoken about mid-income housing and you spoke about 70 lakhs to 1.5 crore. So if you can give us a rough guidance of maybe next 24 months, next 12 months may be difficult. And which are the building blocks to that residential sales?
So look, the building blocks to the sales guidance are 3. One is obviously the existing inventory, including Camellias. B is the Midtown JV with GIC in Delhi. And C is these independent floors in all the 3 locations, Gurgaon, New Gurgaon, and the Tri-City of Chandigarh. Those are the 3 designated locations for launching these, frankly. We are doing a quantification, and we'll be happy to share that quantification with you. I think by the time the Q1 leasing, the Q1, cycle ends. Right now, given the uncertainty, we have desisted from giving a sales guidance right now. What we are hoping, if all goes well, is that by Q3, we should come back to at least a reasonable quarterly clip of sales. But again, I think for a quantification of how we see sales cycles from Q3 onward, I think we would, in all fairness, it will be best if we sort of let this at least current phase of uncertainty to be slightly, navigated, and we should hopefully come back to you by the end of Q1 to give you broadly how the current year is looking. Except that we still hope that by Q3 we should come back to a normal sales cycle.
Sure. So you're saying Delhi, Gurgaon, and Chandigarh would be the place where you look to capture.
Gurgaon again has 2 phases: the main Gurgaon city and the new Gurgaon. So they are 2 different parts. Yeah.
Sure. So just the thought process when there are a lot of corporates in India trying to build up real estate business. I'm talking about Godrej, Tata, Birla. You being the advantage in terms of land position, and this is a difficult time for most of the developers. Why are we thinking about scaling up the business? Because I believe you have a right to win and right to scale up now, and this is a time for you when your balance sheet is not stretched. Why aren't we thinking on those lines?
So you're saying of buying over some stripped land parcels? Is that what you're saying?
I'm saying that you can scale up the business in a couple of more cities where you're present. You can accelerate your sales.
Really, if you see, between Midtown, the independent floors, and a couple of other projects which we are thinking about, I think we're already talking about 10 million square feet of residential launches in this phase. Total pipeline is about 30 million plus, but in this phase, and plus about 3.5 million of the Hines project. So we would be having about almost 31 million square feet of sort of the launch pipeline in that sense, ready. And I think, frankly, that's what our current appetite is.
That's strong. But I'm just saying that the cities will be confined to Delhi and Gurgaon only, majorly. That is where you are thinking about. I'm just trying to build up. Or you will.
Look, NCR and to some degree Chandigarh, our new developments are going to be. And we think that at least for now, for commercial developments, we are clearly, a national player. But for residential development, we would still want to focus on the NCR market. But I think there's still a huge depth in the NCR market because a lot of the so-called inventory overhang, we don't see it ever getting completed in all fairness. So really, I think much of that demand will eventually come back to projects where the customer has a pipeline, has a line of sight to seeing those projects complete.
Sure. Thanks. Thank you. Wish you all the best. Thank you.